You know that mountain of paperwork you sign when you get a mortgage? Well, it's way more than just a loan agreement. It's really your entry ticket into this huge, hidden financial ecosystem. But have you ever stopped and asked the most basic question of all? Where does that giant pile of money actually come from? Well, today, we're going to follow the trail.
You'd think the answer would be pretty simple, right? The bank gives me the money. But the reality is, well, it's a fascinating journey. We're going to trace that cash all the way back to its source, starting right where you do, the moment you apply for the loan.
So, our journey kicks off on what you could call the main stage, the primary mortgage market. This is it. This is the spot where you, the borrower, shake hands with a lender and a brand new loan is created. It's the official birthplace of your mortgage. Okay, so who are these players you meet on the front lines? Well, they're the familiar names you see on your main street, the institutions that actually originate the loan, handle the paperwork, and, hand over the check at closing. The ones you probably know best are depository institutions, and they all work on a really similar principle. You've got your commercial banks, which use the money from all of our checking and savings accounts. Then you have savings and loans, which were literally invented for this, people pooling their money together to help each other buy houses. And of course, the nonprofit credit unions do the same thing for their members. The key thing to get here, at this first level, it's actually the community's own money that's fueling homeownership. Kind of cool, right? But these days, it's not just your local bank. There's a whole world of specialists out there that focus only on mortgages. And this is where things can get a little confusing, because two of the biggest players, the mortgage banker and the mortgage broker, sound almost exactly the same. But they're not. Not at all. And getting this difference is absolutely crucial if we want to keep following the money. Just think of it like this. One of them is a direct lender, and the other one is more like a matchmaker. Let's break that down. So here's the big difference. A mortgage banker actually gives you the funds. Now, they often borrow this money themselves from a bigger bank using something called a warehouse line of credit, and then they lend it out to you in their own name. A mortgage broker, on the other hand, doesn't lend a single dime. They're the matchmaker. They connect you with a whole bunch of different lenders to find the best deal. The loan is always funded in the lender's name, never the broker's. And then you've got this interesting hybrid player, the correspondent lender. They start out acting like a banker. They fund the loan in their own name. But here's the twist. Almost as soon as you sign the papers, they turn around and sell your loan to a much, much larger lender. This model has become super common in the market today. So we've met the folks on the front lines, but a lot of them, especially those mortgage bankers and correspondent lenders, end up selling these loans, which begs the question, who's buying them? This brings us to the next layer of the onion, the big institutional power brokers. And this is where the scale just gets mind-boggling. I mean, think about the billions of dollars managed by life insurance companies and huge pension funds. They take all our premiums and retirement contributions, and they have to find safe, long-term places to invest it. One of their biggest solutions? Mortgages. They buy up thousands of individual mortgages, bundle them all together into something called a mortgage-backed security, and treat it like one giant stable investment. Just like that, your mortgage just went global. Another huge player you'll find here is the Real Estate Investment Trust, or REIT. Congress actually created these way back in 1960. The whole idea was to give regular people a way to invest in massive commercial properties, like skyscrapers or giant apartment complexes, without having to, buy the entire building themselves. The process for the most common kind of REIT is actually super simple. First, they'd buy a property, then they collect rent from all the tenants, and finally, after paying their operating expenses, they're legally required to pay out almost all of that net income to their shareholders as dividends. It's a really direct way to channel investment money, maybe even yours through a 401k, straight into physical real estate. Okay, so we've seen the big institutional highways that money travels down, but mortgage money can also show up from some much more unconventional places. To get this next source, we've got to understand the difference between a stock and a bond. When you buy a share of stock, you own a tiny piece of the company. A bond, though, is totally different. It's just a loan. When you buy a bond, you are lending money to a company or a government, and they're just promising to pay you back later with interest. So what does this have to do with housing? Well, governments can sell very specific bonds to fund very specific projects. A city might sell municipal bonds to build new low-income housing, or even mortgage revenue bonds with one single purpose: raise cash to give first-time home buyers a loan. It's a pretty fascinating way for public money to directly fuel private home ownership.
And now, for maybe the most direct path of them all. Let me just ask you this. What if the person selling you the house was also the bank? It sounds a little strange, I know, but it happens all the time in what's called seller financing.
Here's how it works. Let's say this house costs $150,000. The buyer comes in with a down payment of $35,000. Now, instead of going to a bank for that remaining $115,000, the seller provides the loan directly to the buyer. So the buyer makes their monthly mortgage payments to the person who just sold them the house. It's definitely not the most common way to do it, but it can be a really crucial option, especially for unique properties or buyers who don't fit the traditional mold. So here's the big takeaway. That loan you signed for, it's not just a simple two-way agreement between you and a bank. It's a financial product. It gets born in the primary market, it's often funded by your neighbor's savings account, maybe arranged by a specialist broker, and it could even be sold to your very own pension fund as part of a massive global investment strategy.
It's this incredible, invisible web connecting your front door to some of the world's largest financial institutions. So the next time you look at that monthly mortgage statement, just remember the unbelievable journey that money took to get to you. And knowing its true origin story, does it change how you see your own mortgage?